Hi everyone, welcome to the next video in the series of variances. We'll be discussing here labor variances, and this has everything to do with how much you pay the labor, how many hours they work, how many hours they don't work, how many hours they should have worked, and so on. In some ways, labor variances are quite similar to material variances. I'll explain that as we go on. And as usual, at the end, we'll have an example, a question where we'll calculate all the variances. So we have four variances in labor variances. You have labor idle time variance, you have labor rate variance, efficiency variance, and total variance. The first one, labor idle time variance, is the simplest variance that can be there. Idle time means your labor was available to work, but you didn't have any work for them, so they were sitting idle. This is not the labor's fault. That is why, even though they're sitting idle, you have to pay them. And because of that, as it suggests, any idle time variance will always be adverse because you're paying your labor, but they are not working. So this is quite a simple one. It is simply your idle time into your standard rate or standard hourly rate that you pay your labor. The second variance, labor rate variance. Think of this variance as your material price variance. It is quite similar to that, except that the word material has been replaced by labor and price has been replaced by rate. And other than that, it's pretty much the same. So in this case, what we are comparing is how much should have been the hourly rate as per your standard compared to what was the hourly rate that you've actually paid to the labor for the total number of hours that have been paid. When we say total number of hours paid, that includes the hours that were actually worked as well as the idle hours. So in terms of a formula, we can simply say it is the difference between the standard hourly rate and the actual rate that you have paid the labor into actual hours paid. So using this formula, you can calculate that variance. Again, if the hourly rate is more than what it should have been, it's going to be an adverse variance, else it will be a favorable variance. Coming to the next one, labor efficiency variance. Again, think about this one as your material usage variance. That means what this variance compares is the number of hours that it should have taken to complete the actual production. If you ended up taking more hours than you were supposed to, it's going to be an adverse variance. If you ended up taking less hours than you were supposed to, it's going to be a favorable variance. So here, when you consider the actual hours, it's not the actual hours paid, but the actual hours worked. So in some cases, it may be that you paid, let's say, for 100 hours, but out of those 100 hours, 10 hours were idle. That means the labor actually worked only for 90 hours. And it's fair that we compare their efficiency only for the hours that they have worked, not the hours they were sitting idle. So in this case, the formula could be something like your standard hours for actual production minus actual hours worked into your standard rate of pay per hour. So using this, you can calculate the labor efficiency variance. And then the last variance is your labor total variance. This is the difference between what the total labor cost should have been for actual production compared to what it actually was. Again, this is something like your material total variance. So here we can say your labor total variance is nothing but the sum of your labor idle variance plus labor rate variance plus labor efficiency variance. If you want to write it down as a formula, we can simply say it is the standard hours for actual production into standard hourly rate minus your actual cost of labor. And this would be the same thing as your labor total variance. So these are the four variances that we calculate here. So a quick recap, idle variance is the simplest one. It will always be adverse, whereas your labor rate variance is like your material price variance, labor efficiency is like your material usage, and labor total variance is like your material total variance. So let's move on to a question and let's solve that. We can have a look at all the four variances in much more detail. So you have a standard over here and the actual outcome. Let me just increase that. Yes. So in terms of standard, you're supposed to produce 10 units where each unit requires 20 hours. Hence, the total hours required to produce those 10 units is 200 hours. The rate of labor or the standard rate of labor is $16 and hence the total expected cost of labor is $3,200. In reality, we produced 15 units and we paid our labor for 250 total hours. Out of this 250 hours, 10 hours were idle. They were paid at a rate of $17 per hour and hence the total cost of labor for 250 hours was $4,250. So let's move on to calculating the variances. Your first variance, that is your labor rate variance, is your standard rate minus your actual rate into actual hours paid. So this means your standard rate was 16, but what you actually paid was 17. That means you've paid $1 extra into how many hours paid? 250, and hence this means it is $250 adverse. So simple calculation there. Moving on to the next one, that is your labor idle variance. It is simply what? Idle hours into standard rate. So our idle hours were how much? 10 hours into standard rate, that is 16, and hence your variance will be $160 adverse. Remember, idle variance always adverse. Now, labor efficiency variance. Efficiency variance is what? Your actual production into standard hours compared with the actual hours worked into standard rate. So actual production was how much? 15 units, and 15 units should have taken how many hours? 20 hours each. So that means we are looking at 300 hours. But how many hours were actually worked? Out of 250 hours, 10 hours were idle. So we actually worked only for 240 hours. So what this means is you should have spent 300 hours, but you spent only 240 hours. So that is 60 hours favorable into your standard rate, that is 16, and hence 60 hours into 16, you get, let's just do a quick calculation. You get $960. Okay, now we are back. So this is $960 favorable because you've used 60 hours less. And coming back to your labor total variance, that is your labor rate variance, labor idle variance, and labor efficiency variance. If you add all three, remember adverse is a negative number, favorable is a positive number. So we can say 250 adverse plus 160 adverse plus 960 favorable. What you should get is 550 favorable. Let's verify this. So your actual production was 15 units. It should have taken 20 hours, that is 300, and 300 into 16. It should have taken 4,000. It should have costed you $4,800, whereas in reality it costed you how much? 4,250. That is $550 less, and hence this is a favorable variance. So in this way you can calculate all the 4 variances for labor, and again remember, total variance is your addition of all the 3 other variances. As usual, variances have to be favorable or adverse. So I hope this example helped explain all the 4 variances in detail. As usual, if you have questions, please email me. And if you find these videos useful, please subscribe to my channel and share the link with others who might benefit from it. Thank you.